What's going on, guys? Mike here, and in today's video we're going to be going over the big changes that I was kind of hinting towards in this last video here. And of course, if you're not new, you already know what it is, and that's how I decided that I was moving my $20,000 Locked LIRA to Questrade. So if you're new to this channel, welcome, and Questrade is brand new to this channel as well as to myself. I'm a pretty big believer in Wealthsimple, but considering they don't do Locked LIRA self-directed accounts, I was kind of forced to choose something else. So I ended up choosing Questrade, and in today's video, we're going to be kind of going over what I purchased and why. And I think it's the why is that it is the most important part of this video. So I'm going to show you right here. It's a little anticlimactic, and I apologize. And I bought XEQT, which is, in regards a little boring as an investor, but I'm going to go into why this is so important as to why I chose XEQT. I also did a lot of research on, some further research, because obviously as an investor, I'm just continuously learning. I'm not going to sit here in front of you guys and say I know everything about investing. It's a continuous learn, right? So since I was moving over another $20,000, I really wanted to take my time, and I spent about 2 weeks of kind of thoroughly investigating what I wanted to buy and why, right? So I ended up going with a 90-10 portfolio, which is basically what I have in my RSP, which is on my Wealthsimple account. But I also chose 90-10 here. Now, when I had the last video there that I linked earlier in this video, I had a completely different plan. I was not buying XEQT, and I wasn't buying bonds. So completely derailed my plan. But I went with a 90-10 XEQT and ZEG as my bond ETF. So I hope this makes sense, but I'm going to try getting into why I chose what I did. So before I can kind of answer that, I need to show you the stats, okay? So for some of you, you may already know, but XEQT was developed in 2019, and XEQT is an ETF of ETFs. So you'll see here on this portfolio backtest, I actually, on the top here, these top four are XEQT. These are the individual ETFs that it holds and its weightings. So for me to do an analysis 5 years ago, which starts at 2017, I needed to use the individual ETFs versus just being able to use XEQT, sadly. So I hope that makes it clear as to what I'm doing here. And so you can see these are the weights that if you go and you look at the XEQT's website, this is what it holds. So I have basically two portfolios I'm showing you here. My Questrade portfolio as to what I actually purchased and what I was actually considering. So let me explain what I was actually considering as well. So my logic or my theory was I wanted to do kind of the top weightings in top companies, right? So VFE being the top 500 companies in the S&P 500. And I also wanted to do VDY. Now, this technically isn't focused on the top companies in Canada, but they're like the top dividend payers, which in my opinion are like the top, they're the good old and faithful. They're the top players, in my opinion, in Canada. And there's about 57 stocks in there right now. So again, weighting 33% each on those two particular ETFs. Then I was adding in a total index of Canada and a total index of the US. So my theory behind this is that I was overweighting myself on the top companies in both of those countries, but then by having the total indexes as well at a kind of a smaller weighting, I was also still getting exposure to the small cap and the medium cap companies, which was what my theory was. And then I also had a 9.25% into XEF, which is the international exposure that I was going to give, which is like, Australia, Europe, and Asia. Okay. So that was my theory. So looking at past performances over the last 5 years between XEQT and my version of the portfolio, you can see the compound annual growth rate was higher, which I was like, okay, this is looking good, right? Now, again, you can't necessarily expect past performance to mean future performance, but it was just kind of what I was going off of right now, right? So also too, if you just kind of look at, year to date, technically, it's only doing 8% compared to XEQT. Year to date is 8.68. but it beat it, if you look back a full year, a full 3 years, and a full 5 years, obviously. So obviously, when you consider just XEQT, you basically have, obviously the professionals that are managing the weighting, and they might make a change. Like they just made a change on the emerging markets ETF. So they changed it from like IEMG to that XEC, right? Which is a new ETF that they just swapped in recently. And the weightings, adjust ever so slightly. Like a couple months ago, it was at 45%, US. Now it's at like 43. There's just a little bit of deviation, right? But it's all roughly the same. Anyways, so I was also kind of looking at my current portfolio being in my RSP and my TFSA, which is obviously on Wealthsimple. So if you're new to the channel, that's where those guys are. And I'm at, last month, last end of last month, I was at 6.3%. Well, if you look at if I just purchased just XEQT, I would have been at 8.68. So my mind started thinking, it's like, okay, am I making good choices? Now, I still am very happy with my RSP and my TFSA being at 6.3%. There's no issues there. But again, like I've said before, I'm personally not a professional, right? And a lot of times when you're doing DIY, it is a little bit of like the emotional roller coaster. And sometimes you make choices based on your emotions. Whereas in XEQT, hopefully they're not, right? Hopefully they're not making emotional choices. But so I started like, second guessing myself. So it's like, when I was looking at VDY, which is a big contributor to that 10% compound annual growth rate in my version of the back test that we just did, I started looking, okay, so, VDY, if you look at the performance of it, obviously this doesn't include dividends, but it didn't have like substantial capital growth. And when you look at it, when there was only a 0.25% overnight rate from Bank of Canada when 2020 hit, it had a substantial amount of growth, which again is contributing to the 10% compound annual growth rate on the back test. So can we expect that this is going to be similar in the next 10 years or the next 5 years, right? And my theory is probably not, right? The financial sector is not going to do so well compared to previous years because interest rates aren't going to be as low as they were. Depending when you get in, you might do still extremely well. I still own like TD stock, and I'm not like selling it or anything like that. But we're not necessarily going to see this like 70% growth from when COVID hit, when interest rates were so low. So then I started asking myself, like, okay, so is it better for me to just kind of set and forget, let the professionals do it, because they probably know better than me, right? And it's probably the case. So that's another reason why obviously I went with XEQT, especially with the LIRA account, just because I can't like contribute anything more to it. It's more of like I have $20,000 there. I just need to let it do something and let it grow, right? So I went with a 90-10 portfolio with the bonds. Now, why did I add bonds to it? Now, I do have bonds in my RSP account on my Wealthsimple, but I'm not usually a big advocate at my age, which I'm 33 years old, to hold much bonds. Now, a lot of research I was kind of going into, and I kind of stumbled across the Boglehead subform, which then led me down a ton of like white papers and documentation on the internet of this strategy. And of course, they typically always say you should have a maximum of no asset class of like 75% and no minimum of 25%. So if you have 75% equities, you should have 25% bonds and vice versa, right? Now, I didn't follow that, obviously, but what really intrigued me was how there was a lot of documentation online that go into details of, the misconception of going 100% equities. Now, there's always, there's danger in always being so exposed to the volatility of the market. Now, it also goes into detail that there's evidence in previous years that bonds did actually outperform equities. So if you're going all equities, you're actually taking a risk of always or potentially not having good returns, because what happens if it's actually bonds that are performing good and not equities for like say a 5-year stint? Now, it's rare, it hasn't happened very often, in the course of hundreds of years, but it does happen. And is there anything saying that the future is going to be exactly the same as the past, right? So Also too, there was some evidence online that depending, if you took, I can't remember the exact years, but if you were like invested for like 80 years, there was chunks in a portfolio, and I can't remember which ones they were, that actually did better as an 80-10 portfolio than a 100% portfolio of equities, just because you had less volatility, which meant you had less to recover when you say the equities were doing really bad. So that's just something to kind of take note of, right? Just because you're 100% equities doesn't always mean you're going to have the best returns if it's going to be possible, right? If there's years that bonds do better, then an 80-10 an 80-20 portfolio will actually do better than most 100% equity portfolios. So that's just something to kind of be aware of, right? And I just really wanted to share that with you. And so I felt like I said, I kind of made it a little like, ooh, what am I going to buy in my next video? And then I ended up buying XEQT. So I feel a little guilty on that, and I apologize. But with further research, I just decided, it was better for this particular account to be a set and forget, right? I don't want to, especially because I'm also paying commission fees on Questrade as well, right? So ETFs are free to buy, but you still pay like these small like ECN, fees and that kind of thing. And if I was buying 4, ETFs versus just the one, technically I'm paying more fees, and that I don't really have to just get it through one ETF. Also, too, thinking long term, when it comes time to start living off of my, investments, if I have to sell, say $30,000 worth of stock that year for my income, if I have to sell it from 4 ETFs versus one, again, I'm saving on those fees as well. So those are just all kind of things to kind of consider. But yeah, so I hope that information was helpful. I'm not necessarily, moving away from my current plans and my TFSA and my other RSP. I'm still staying the course on those guys. But this particular one, since I can't add to it, I just wanted it to be more of a set and forget. Let the professionals handle it. If they're getting 8% this year, I'm only doing 6% this year. I kind of wanted to see how it compares in the future here as well. Also, too, if you like this information, definitely subscribe, because we'll be obviously comparing month after month and year after year of how maybe my 70% XEQT portfolio mixed with some individual stocks performs compared to that, and all that kind of stuff, right? So we'll be able to kind of compare and see which one is actually performing better, and in different market conditions and all that kind of stuff. So definitely subscribe if that's something of interest to you. To kind of go over, so here is the portfolio trade log. So you can see here I bought the 716 stocks of XEQT and the 155 of ZAG for the bond allocation. In the TFSA, we also received some dividends, not much, only $3.11 from the real estate REITs that we hold within the portfolio. And yeah, so one of the things I also want to point out too is right now, year to date, now that I added in such a large chunk of cash into this Excel sheet, my money weighted returns look really terrible, because $20,000 is a large portion, because right now I'm at 48,000, so it's just below 50% of the actual worth of my investments on this channel. So I just want to show you that, like, if I actually get rid, oops, so I'm gonna go back here. If I actually get rid of those purchases, we'll actually see what the rate of return was this year. Just because, of course, like I said, it kind of skews with the results a little bit now. So it'll just take a few seconds to update here. So I just kind of want to point that out. So in the future videos of this year, until we kind of get a full year of this money sitting there, it's going to kind of skew the results. So like last month, at the end of the month, I was at 6.3%. Obviously, we've had some significant red days since then. So now I'm down to 4.9% overall between my RSP and my TFSA, with a total of $370 of dividends. So I'm just going to add those stock numbers back in here. So just kind of wanted to quickly point that out. So I also want to just kind of update you guys on the dividends as well. So with the additional $20,000 that have been allocated into this channel now, the annual dividends has shot up from just over $850 to now $1,304 annually. So it's pretty cool to kind of go beyond the $100 mark per month. So yeah, just kind of wanted to update you with that. So that's kind of everything I have for today. If you guys have any questions, definitely make sure you leave a comment below. Like the video if you actually did like it. If you didn't, well, please like it. Otherwise, definitely subscribe to the channel for future content, and I'll see you guys next time. See ya.